Good morning, Humanities 130 students. We're going to be finishing the Basic Accounting Principle PowerPoint Part 2. I'm sorry for missing class Wednesday, but I feel like I got hit by a truck. So, we left off, we were talking about the balance sheet, and now we're going to go over the income statement, the statement of cash flows, and the statement of owner's equity. Again, I'm not turning you into an accountant as much as trying to get you to have a certain literacy in financial matters so that no one can take advantage of you. So let's look at an income statement. This is one of the most important pieces of financial records that any company has, and you can even do this for yourself, which is why I had you write down your expenses for a week. So it is a summarized list of income and expenses, and it represents a specific period of time. So, for example, you can do it by the month, by the quarter, or by the year. The example that I have listed over here on the right-hand side is by the month, January, February, and so on. And it identifies if a company made a profit or a loss during that specific time. So if you look at the income part, now this company looks like it's some sort of construction, or they do work for homes and businesses. They have their income listed by the job. So they made $21.50 both January and February at job at XYZ company. And then you'll also see the same situation at Main Street, 106.59 both months, and then 6407 Sleepy Hollow Drive, $156 a month. So that could be something like snow removal, something that we are very familiar with. And then here is $495 just for January, and it says small business. So this is your total income. This is how much money you have earned in that particular month. And then also over here, so you see a slight dip for February. Then we have our expenses. This is any time that you have to put out money for a particular job-related expense. Now, a lot of these, like for example, groceries and education and dining, may not seem like obvious expenses. But depending on the type of business it is, anything can be an expense. For example, if you're running a snowmobile business, having to make snow for fields might be an expense. Although, of course, in New Jersey and Pennsylvania and Delaware this week, we don't have that problem. Now, once all the expenses are listed, we do the total expenses. You'll see in January that this person made a net income of $64.04. Go to the next month, and he's actually lost money. When you see any number in red with parentheses, that means a loss. That is not a good thing. So he lost $430.96. What this does is it tells you if a company is paying its bills or if it can pay its bills. If you see a frequent situation where the expenses are larger than the income, this is not a good company. Whereas if you see it go back and forth over the course of a year, that's usually pretty normal. Most companies that are small businesses, they are literally just getting by in a lot of ways, unless they have a specific time period where they're going to make their money. So for example, a toy store generally runs a loss through most of its business, but in November and December, that's when all of their sales hit for Christmas. And you'll see a company like Toys R Us struggling for 9 months, and then their last quarter, December, November, and October become their big money maker for the whole year. With shore businesses in Wildwood or Atlantic City or Cape May, you see June, July, August, September, and parts of October being their money makers. And then the rest of the year, their expenses are definitely going to be far higher than their income. The point I'm making is you also have to keep the context of what kind of business you're looking at. because some businesses will make a ton of money for 2 or 3 months of the year and then just limp by the rest. That doesn't mean it's a bad business. It just means that there are cycles of what we would call their busy season. The other item that we're looking at is called the Statement of Cash Flows. It is a historical record of the sources of funding or your cash. Where is the cash coming from? Cash comes from three main activities in any business. Operating activities. That's the actual money that's being made by the business for business activities. Then there's the cash from investment. So when grandma gives you a $50 savings bond when you're born and it comes forward, it comes due when you're 21 and you get that $50, that's an investment. That's an investing activity where you get cash. Financing activities are those scenarios where you get money for a bank loan. So, for example, you need $20,000 to cover payroll this month. You get a bank loan for $20,000. Well, in that scenario, that is cash that you are receiving. Of course, you're going to have to pay it back. So you'll see on the example that a repayment of loans comes off of the $50,000 loan that you got from the bank. Now let's go through this entire cash flow. So this is First Church, Statement of Cash Flows for the year ending December 31st, 2000 and whenever. Cash flow from operating activities. So it's church. So they get their cash receipts, they get contributions and offerings. That's when they pass the basket around in church. And they made $55,000. Their event receipts. So when you see a church running a bingo game or they're having a carnival, they're making money from that. And in this case, it's $21,000. So their total receipts are $76,000. That's how much cash they brought in. Cash disbursements. That's how much cash they had to pay out. So in this case, $25,000 could be all of their bills for the month. Their mortgage, the amount of money that they have to spend for electricity, phone service, cable, because, churches need Wi-Fi and all the others. So their net cash from operating activities is $51,000. Then we have our cash flow from investing activities. Now what you're going to see here is this parentheses. What the heck is that about? Remember, that's a negative. So they purchased property or equipment and it cost them $50,000. So that's a negative cash flow, meaning they put out the cash. Then we have cash flow from financing activities, which we already talked about. So you take these numbers that have the double underlines and you add them together. So 51,000 minus 50,000 is $1,000. Then you take the 40,000 and you add that to the 1,000 and that gives you 41,000. At the beginning of the year, the church had $10,000 in cash. At the end of the year, the church has $51,000 in cash. And that's a very healthy improvement over the course of that year, keeping in mind that a vast majority of that is a loan from a bank. So again, you have to be able to look at and see what these people are spending their cash on and where their cash is coming from. So the fact that most of their money that they have is from a bank loan is not as healthy as if they did not have the bank loan being their primary source of funding. However, keep in mind that they did spend $50,000 on the purchase of property, land, and equipment, which means that they're investing in something specific. Lastly, we're going to be looking at a statement of owner's equity. And this explains the change in owner's equity between two balance sheets. And you could have a balance sheet for the year ending 2012 and then another balance sheet for the year ending 2013. And these changes are due to a variety of reasons. For example, net income. If you make a huge profit one year, and as the owner, you get to cash in on that profit, meaning that profit is going to come to you, that is an excellent way for the owner's equity to change. Other things, changes in inventory valuation. So the example I gave in class was about gold. So if gold is selling for about $1,000 an ounce and you're a jewelry store owner, your jewelry is going to be valued at a certain amount. But let's say, hypothetically, that the value of gold goes up to $2,000 an ounce. That means that your inventory is now twice what it was. And what that does is that increases your asset, because your prepaid inventory is an asset, which also means that that's going to increase the amount of money that you have in the business, that you as the owner have in the business. Other changes can also include family living withdrawals. This is especially true when you have a small company and your family depends upon any profits that come from the business to pay its bills. So, for example, if you have to pay your mortgage, you're going to take out a family living withdrawal. These are completely legal, especially if you have a small business. The larger the business, especially if it's a corporation or a partnership, these things get a little more complicated. Now, the last two here, one is capital contributions and the other one is capital distributions. So a capital contribution would be if your company is not doing great. Let's say it's the slow time and you need to take your personal money and put it into the business. That is also going to change the level of owner's equity. That's going to increase it because you're putting your money, your personal money, maybe that $50 from grandma, and putting it in the business. So that means you're going to have more of the business. But the other thing is you have capital distributions. So for example, let's say you have a partnership and you and your partner are not liking each other very much these days. So your partner says, I don't want to be in this business. I want my money and I'm going to get out of here. So you have to then take whatever money he or she put into the business and return it to them, depending on the legal agreement that was made. This is why you should always have a lawyer involved in these kind of things, because they will in fact tell you how much money a partner can pull out at any one time. It can be catastrophic if you have a company where your assets are not easily convertible into cash. Now that we have our 4 types of business reports, we also want to look at what do we do with these business reports? Well, we analyze them. And all business owners should understand how to analyze and interpret their financial reports. That's going to tell you whether or not your company is healthy or unhealthy. So the first objective for financial analysis is to measure the financial condition of the business. Secondly, measure the financial performance of the business. We went forward a little bit. Sorry about that. Then that means that you got another $42,000 in your actual ownership. So you went up 5%. So even though it looks like you didn't have such a great year because you decreased in assets, you actually had a really good year because you got more money for your company, for you, your debts went down, and your assets did go down a little bit, but not significantly. One of the other things that we're going to be looking at in more detail this semester is called financial liquidity analysis, and we're going to be talking about this in more detail throughout the semester. Liquidity means how easily an asset can be converted into cash, and there are 2 measurements we're looking at here. Current ratio, which is the current assets divided by current liabilities. And if you have less than 1, that is bad. Another one we look at is working capital. This is current assets minus current liabilities. And if you have a negative number, that is bad. Again, we'll be talking about these analysis numbers in way more detail when we go through the semester. We also have what's called a financial solvency analysis. This is the ability of a company to repay all of its financial obligations. In other words, can you pay what you've already spent? We're going to be looking at 3 specific ratios, and again, what we're not going to be doing today, we'll be doing in much more detail later on. So the first one is debt to asset ratio, and this is your total debt liabilities divided by total assets, and greater than 1 is bad. For the quiz, you'll be given the actual ratios, and you'll need to know whether or not it should be better or worse than 1. So in other words, if it is more than 1, is that good or bad? Equity to asset ratio, which is total equity divided by total assets, and we'll talk about that in more detail. And then debt to equity ratio. This is your leverage ratio. And again, less than 1 is better. Now, as we finish up this particular part of the class, what I want you to think about, measures are only as good as the data that's being used. If a company is giving you bad data, that means whatever decisions you're making are technically not your fault, because it is really the responsibility of a company to put out good data, and that's when they get in trouble. So in the Enron video that you were watching, they had that mark to marketing accounting cycle, which basically meant that they were taking revenue based on an idea, not on actual sales, but on the idea of what they could sell. Obviously, it doesn't take a financial genius to know that that is not the best way to manage any kind of accounting cycle. The other consideration is methods must be consistent between years and between operations. In the most simplest terms, you can't compare apples to pineapples. It's not going to be the same fruit, they're not the same size, they're not the same kind of fruit. It has to be apples to apples, pineapple to pineapple. And then that's going to give you a much better idea of whether or not the company has a good performance and whether or not they have a good potential moving forward. So just to look at this data right here, we look at revenue. Revenue in 2006 was $1,268. In 2008, when it had its best year, 1,664. And in 2010, 1,582. What you see is a slight increase, and then, in 2008, just remember, we had our big financial problem in this country and around the world. So we went into a recession. So it makes sense that the numbers went down for 2009 and 2010. But what you do see is a slight uptick for 2010. Slight, small, but what you see is a small uptake, which means that they are staying healthy. Now, this number down here is your net income. And yes, it's all in millions, but I'm just using the easier number because I can barely breathe today. Don't you feel sad for me? Anyway, in 2006, our net income was 108. The best year in 2008, we had 139 income. Now what you see here is in 2010, our net income is 61. And yet, our revenue is 1,582. Now what is this telling us? This is telling us that it's costing us more money to make these sales than it used to. So it might be an idea that this is your revenue. What's not listed here is the expenses. So you can easily figure out what the expenses are because what you're looking at is this is your net income or your profit. So they still are making a small profit, but it's costing them more money to make their revenue. This is going to finish up this particular section. We're going to start Chapter 3 next week. Our quiz will be on Monday. Know whether or not something is good or bad based on the ratios. You don't have to memorize the ratios, but I'll be giving you numbers that you will then say, yes, this is a good ratio, or no, stay away from this company. If you have any questions, feel free to text me, and I hope you're all staying warm and safe during the snowstorm.